Welcome everyone. This is Mike Connor, and I'm your host today for our Innovation Trailblazer series. Today, our webinar is going to focus on innovations in commercial underwriting, where we are today and where we need to be tomorrow. Our goal is to really give you the insight that you need to basically either get underway with this and or to change direction as appropriate. I've got some marvelous speakers. We'll introduce them in just a second. And what we'll do is kind of walk through what's driving the changes in underwriting today, what it takes to really bring underwriting excellence to life and some examples of that, the technologies that are underpinning some of that, and then we'll drop into what the implementation challenges and best practices are. And finally, we'll wrap up with how do you basically put together a convincing business case to get the support that you need to undertake this work. As I said, this is part of the Innovation Trailblazer series. We've got a number of pretty awesome webinars coming up. And if you get a chance, get up to our website. You can check us out at sviaaccelerator.com. And our event page has got that information on it. I'd like to take a moment here and thank our sponsors. Majesco has been with us since the beginning and really appreciate all the work and support and guidance that we've gotten from Denise and Majesco in doing the work we're doing. So thank you guys for that. Instanda is now with us as another sponsor, and we really enjoy the work that they're doing in the marketplace, bringing some new, fresh technology into the streets. We've got Chisel AI as a sponsor as well, doing some amazing work in the world of artificial intelligence and machine learning. And then we've got Hazard Hub, who's basically bringing together some great data sets, geospatial data sets on property data. So really appreciate you guys for all your support. Thank you. And now what I'd like to do is introduce our speakers, or have our speakers introduce themselves. So I'll stop sharing. And Denise, let's start with you.
Hi, welcome everybody, and good to have everybody join us again today. Denise Garth, I'm Senior Vice President for Strategic Marketing at Majesco, and we are a provider of core systems, a digital platform with our digital first insurance platform, distribution management, and a, data and analytics solutions for both P&C and L&A. I'm looking forward to the conversation.
Great, thanks Denise. And Bob?
I'm Bob Frady. I am co-founder and CEO of Hazard Hub. We, in essence, tell you all the bad stuff that can happen to a property. Whether it's personal lines or commercial lines, doesn't matter to us. Bad stuff happens to both.
Got it. Thanks. And then Ron?
Hi, everybody. Ron Glosman, CEO and founder of Chisel AI. We're a provider of artificial intelligence solutions focused on teaching computers how to read common documents like claims documents, policies, binders, etc. Today, the main focus is on helping you reduce your errors and omissions through policy check and help you write more business through submission intake.
Awesome, thanks. And Greg?
Welcome everybody. Greg Murphy, Executive Vice President of Instanda for North America. And we are a digital policy administration platform that is really focused on bringing products to market very, very quickly in any type of distribution channel. So we are looking forward to the discussion today, and it'll be interesting to talk about how to make this whole underwriting journey better.
Great. Thank you all, and I'm going to start sharing my screen again. In a moment. There we go. All right, so what I'm going to do is walk through a kind of a quick introduction to set up our discussion. These slides will be available.
Switch your views. You should swap your views. We see your presenter slides.
I'm sorry?
You should press swap slides. We see your presenter slides.
Yeah. Up top, swap displays.
I'm sorry, I'm not.
We're seeing you, the presenter slides. We're not seeing the full slide.
Oh, interesting.
The third button from the top left, swap, swap displays.
Got it, thank you. Try this again.
You have all kinds of help, Mike.
Yeah, I appreciate it too. Thank you.
Yes.
All right, so let's go here. All right, so let me share this, and then I'm going to go here and share that. So now are we seeing the right thing?
There we
Yep.
go.
Okay, awesome. Thank you guys for the assistance. Much appreciated. Just a reminder to the audience, we have got a Q&A available. We'd love to get your thoughts and your comments as we go through this. We'll try to get to as many of your questions as we can. If we can't, we'll get to you afterwards. And also, you can reach out to any of us via LinkedIn. So if you've got questions and want to follow up on anything, please use that as a primary vehicle to get to us. All right. So as we all know, particularly on the commercial side of things, COVID has kind of put a big hole in GDP and growth in a lot of different areas and put a lot of markets into scramble mode. And so even, you know, in the commercial side, particularly on the small business side, we're responding to that and dealing with that. The other side of that is it's also accelerated the digital economy, and not just for insurance, but pretty much every industry is looking hard at how they need to get their digital act together faster. So the net is the new digital normal has arrived. We're there, and it's accelerating rapidly. Across the board, when you talk to CEOs, and there's been conversations or studies that have been done by multiple different companies now, well, everyone's kind of focusing on what do we need to do short term to shore up our ability to work remotely and accelerate our core processes and those kind of things. The leaders in almost every industry are really now focusing on how do we differentiate ourselves in a digital market? How do we identify new innovative solutions that will have relevance and create value and growth in the new digital normal? And how do we basically relook at our partners and our ecosystem strategies and so on? So this is not only true for insurance, it's true for almost every business or every industry out there. One of the primary focuses now in the conversations that have, or the studies that have been done with CEOs across the board have been a focus, a renewed focus and accelerated focus on digital ecosystems. And so prior to COVID, the expectation was that $60 trillion worth of the economy would basically move through these digital ecosystems by 2025. My guess is that number is going to shift pretty dramatically as a result of COVID. Digital ecosystems are out there across the board, and people are digging into them to try to understand how to take advantage of them, leverage them, bring them into their product capabilities, their customer engagement capabilities, find value-added solutions that they can tie into and bring more value to their customers. So whether it's for supply chains or whether it's for retail or whether it's digital ecosystems for smart cities or things, you know, deep into a vertical like construction and those kind of things, across the board, people are looking at this. And so digital leaders are basically taking that step forward to say, how do I basically leverage that to address the growth opportunities and the challenges I'm going to be facing in the future. And that includes insurance. So the digital leaders out there within the insurance market are looking at the same things. In addition to that, there's some technologies that are accelerating that are also going to have an impact on how we think about underwriting and how we gather information and risk data. And so what we're seeing is an acceleration of just about everything from a technology standpoint that can support this more digital world we're now in, remote working, certainly concerns about health and safety, cybersecurity as we have more and more employees working at home, identity management, all of those things are basically being accelerated, including machine learning and artificial intelligence. And so that brings us to insurance. We also see the leaders in insurance looking at how do we basically tap into these digital ecosystems? How do we find ways to better support our customers by bringing transparency, prediction, prevention, mitigation, and recovery through value-added services, as well as gather information that we need to underwrite these things. In addition to that, and I'm sure we'll hear more about this from Bob, but basically the whole world of globally connected digital spatial, geospatial data is also getting a boost forward, where we're basically connecting data sets across a number of different things that allow us to understand from a geospatial standpoint what's going on in a number of different domains. you know, artificial intelligence and machine learning have been something that every industry has been embracing, including insurance. And that's now really starting to accelerate as well, because people who have done it see the benefits from it. And those that haven't yet done it are basically getting hurt because they're not there yet. So we're going to see more acceleration in that domain as well. There's obviously a bunch of new product opportunities as we tie into this digital world that will come to life, and those are going to require new approaches to underwriting as well. So the net is pricing as usual is probably not going to work very much longer. We're going to have to change the way we do that. And in terms of underwriting, you know, we've got to get far more precise in how we go about that, which means we need to digitally augment the work that our underwriters have been doing in ways we haven't done before. Data-driven underwriting is going to take precedence even in the largest accounts. I won't go through all of this, but you know, you really have to take a holistic approach to where we gather data from, how we use that data, and then basically look at how do we deploy that in the ways that we assess risk, write risk, and create new business products and business models that give our customers more value and give us more growth and profits. I think I love this report from McKinsey. If you guys haven't had a chance to go get that report yet, please do. Future of Commercial Underwriting. But the message here is underwriting excellence isn't easy. It's not. There's not one silver bullet out there that that you can push to get here. It really takes a comprehensive approach that not only looks at you know, kind of the top end of, you know, what are we underwriting, how are we underwriting, and so on, but how you're going about sourcing that, you know, who the partners are that are sending you that business, and the quality of what they're doing, and so on. And then also finding new distribution partners that can get you into new areas of risk that can provide growth and profitability. And so the net is, it kind of takes a comprehensive reset of how you think about underwriting. And what they noticed as they did this study is the people who are really good at this are usually 5 to 6 times better at it than the people who aren't so good at it. So the net is, in this digital world we're heading towards, the ability to do excellent work in underwriting is going to become a pivotal a part of competitive landscape. So that's hopefully a quick intro. What I'd like to do now is turn it over to Denise and have her share with us some of the work that she's done recently on some studies around this. So I'm going to stop sharing my screen, Denise.
Okay.
And
I'm going to share mine. Okay, can you see Mike?
I can. Looks
All
marvelous.
Right. Okay, thanks everybody. So just some insights with regard to some research that we've done with business owners, in particular around their expectations around the types of data that they're willing to share to be able to underwrite and price, and then just kind of some of those overall trends. So first up, I thought what was really important is to understand that while we've been insuring a lot of different businesses out in the marketplace, COVID-19 has really kind of changed most businesses, if not all businesses. And coming out of it, we're going to have a lot of different types of insurance opportunities for new types of businesses or transformed businesses that we've got to think about new types of risk products associated to that. And so as the business models change, we need to be able to change with that. And also with regard to the types of products that we're providing, as well as how we're going to underwrite those products in there. So you can see here everything from e-learning to you know, virtual restaurants to, you know, supply chain excuse me, reshoring, like for drugs. The wide open opportunities are going to have a lot of interesting perspectives, because they're also going to be thinking about how they want to do things digitally themselves and how they want to engage with insurers on a digital basis. At the same time, you know, from a vehicle standpoint, there's a lot happening around vehicles. And in our most recent research around auto, you know, auto insurance is substantially changing. And it's not just about personal autos, it's about fleets of vehicles, but it's about trucks. These are actually Tesla trucks that are self-driving Tesla trucks and have lots of connected data associated to them. All of that is really giving rise to a whole new set of data that can be really used to really personalize that underwriting process for customers based upon the vehicles that they've got, as well as the fleets and the drivers that are using those different types of fleets. And what we're really seeing here is that we're really moving from how we've actually operated as a business model to a very digitally oriented business model. And I've highlighted in red here the pieces that in particular are crucially important from an underwriting perspective. So it's emerging and dynamic risk. The risk isn't going to stay the same day in and day out. With real-time data, you're going to be able to dynamically reprice that risk on a more regular basis, and customers will be expecting to be able to do that. That leads into continuous underwriting, and that leads into dynamic pricing. And at the same time is a whole ecosystem of partners that are going to be able to provide that. You'll be hearing some of that from Ron and Bob Frady, with regard to how they're partnering to be able to provide different types of data and capabilities. And then, it's the whole thing also about risk avoidance and mitigation. It's one thing to underwrite for the risk, but it's another thing to try to avoid the risk, to keep the rates down and to keep the customer happy without having to have a claim. So thinking about that also in the underwriting process, because we've typically looked at losses, we've looked at, the portfolio of a business, over a period of time. If we've had that, we may also want to look at how we can actually instigate in the underwriting process assumptions based on risk avoidance. So what we found in our research is that these business owners are willing to share all kinds of data with you. All of the IoT data, wearable data, that could be in a workers' comp type of a situation. You could have, the vehicle data. You've got the property data from an IoT standpoint. You've got purchase data, social media data, everything. And, the funny thing is that some of this may sound like it's, why would I even think about some of that data? But people's behaviors on social media, or the types of people that are following them, could potentially identify potential risks, particularly as we find in this day and age, how social media is so dramatically influencing a lot of different things. And so I think we got to think outside the box. Our customers are thinking outside the box with regard to the data they're willing to share. We've also got to think about how some of that data may be able to be used, not independently, but with other types of data to really kind of drill down more so into the risk. I know this is a little bit of an eyesore, but if you look at the 5 different categories here, in essence, going across is where it's 50% or more. In essence, on the first group is really around how and when and people drive, so fleets of vehicles. You can see here that they're willing and ready to get it from all generations. This is really broken down by generational for business owners. The third one over is really around IoT data. That's around just any type of IoT data, property data. It could be, wearable data, like from a workers' comp standpoint. All of that, and once again, with the most part, most of them are pretty willing to share that data. And the social media is on the last 2. The first one is on who are your followers, and the second one is your social media posts. So for the younger generation, they're willing to do that, and I think that as we see some of the things that are kind of playing out from the standpoint of some of the unrest that we see in some of the cities and some of the things happening, some of this can really kind of identify some risk. In fact, over in London, a number of years ago, when there was a number of riots over there, they actually used social media, one insurer used social media data to actually track and try to monitor the risk profile and alert their customers relative to potential riots that could be happening near their property, so that they could actually do something around that. So there is real value to be able to use that data, maybe not necessarily in underwriting, but also in avoiding the risk. What's also important is this whole value-added services. So we've got one thing around the risk, but you've also got value-added services that may be built into the product. It may be part of the product. In today's age, product really has to be about the risk, the value-added services, and the customer experience. And in this value-added services, this is where you could actually have some mitigation value-added services to kind of monitor and avoid the risk. But looking at how does that get priced in? Is it a flat fee, or is it really priced into the overall product? I think those types of things are really crucial as you're beginning to build the product and design the product, but then also in underwriting the product. What we're also finding is that business owners are really open to really changing how often they're going to renew. So, you know, traditionally it's been on an annual or a 6-month type of a renewal. They're much more open to different periods of time that they would actually renew that, meaning that they could also reprice at that point in time, and you'd have to re-underwrite. The other thing is that they would also be open to an app or a device, you know, to really kind of monitor things, particularly from a car perspective. But what it all means is that you're going to have a different set of technologies to do a lot of that. And it means that cloud is going to be really important. APIs are going to be crucially important to be able to pull in all of this new sources of data, you know, because at the end of the day, it's going to be about not just the data that you've normally had, both structured and unstructured data, but also new sources of data like the IoT data. And how do you aggregate that all together and apply AI and machine learning on top of it, where you see down there. At the same time, you've got to be able to have kind of that digital experience, because your underwriters really need to have a platform that they can actually look things at a portfolio basis, on an aggregate basis. It's a different type of a process, and how you're engaging with a customer, particularly a business owner, they need to have that kind of digital experience as well. And one thing that I would really highlight here that has to be really thought about is that we can't just assume that the underwriting process is going to stay the same. Mike made that point. We have a workforce shift going on. Not only is the workforce becoming younger because we've got people retiring, but we've got people now working from home and are going to be working from home for an extended period of time. In the past, underwriting could have, you know, gotten up from their cubicle, gone over, and they could have kind of had a collaborative type of a discussion. That's not feasible today. So how do you do that in a different type of an environment using technology? You know, it's the same thing over in London Market. You didn't, you could just walk down the street and you can kind of talk about that. You've got to do it in a different kind of way to be able to digitally kind of engage people and have a different type of a process. So while the data and how you go about underwriting is a key part, the whole process also has to be thought through, which really gets into kind of a digital a platform to be able to really redefine that experience and that process. And the last thing I'm going to leave you with is a statement out of McKinsey's Insurance 2030 report on the impact of AI. And that's less than 10 years away, out now. By 2030, manual underwriting will cease to exist for personal and small business products across L&A and P&C. And it will be reduced from a few seconds to automated, you know, to very automated, and it's in microseconds type of thing. So think about that. That's a lot of change in 10 years, given that there's still a lot of manual processes in place. And we don't have data to apply AI and machine learning to. We have a lot of work ahead of us in terms of process. How do we retrain our people? How do we apply new technology? And how do we really rethink what it is and how we're going to do it in terms of products? So Mike, I'll leave it with that.
Great, thank you, Denise. And then we've got a couple of really good questions that have come in here, and I wanted to kind of put those out to pretty much everyone. So I guess the first question is on the more large bespoke kind of underwriting solutions, where do we actually see technology being able to be brought in to help those as opposed to doing it manually like it is? So let's start there. And I don't know if you have some thoughts on that, Denise, or anyone else does.
Sure.
Go ahead.
Well, you know, when it comes to sort of the gnarly risks out there, you can almost break them into two. One would be you've got a giant installation that needs multiple insurers to help carry the risk. And the second is that you've got a single policy sometimes with thousands or hundreds or thousands of locations. And right now, technology can handle the latter very simply by the integration of database APIs, so that when you have that discussion across the underwriting table, you know what the risk-adjusted portfolio is for your book that you're looking at, or for the policy that you're looking at. Right now, too many insurers just ignore that data because it's so expensive to get. One of the things we're trying to do is to digitize that so it becomes instantaneously available, so people aren't dealing with a stacked deck where maybe the broker knows that, well, okay, these locations are in flood zones, and the syndicate member doesn't know that. You know, that's the kind of thing that digital can address right now in terms of helping to level that playing field.
Yeah, and I would just add to that, that from a large risk standpoint, a lot of times you're dealing with, you can have some structured data, but to Bob's point, you've got a lot of unstructured data. And I think the minute that you can digitize some of that unstructured data, and you begin to pull that in, and you can apply artificial intelligence and machine learning to that unstructured data, you can begin to automate some of that and digitize that. Will you be able to get a straight through process for underwriting? Maybe not initially, but over a period of time, you're going to be, that algorithm and that application of that is going to get smarter with more data that kind of flows through that. And I think that you've got to start someplace that maybe 10 years down the road, we can begin to have some more automation around large risks than we do today. Maybe not the same as small risks, small business risks, but you got to start someplace. And I think, once again, I'm just going to think outside the box of the types of data that you might want to use, both structured and unstructured.
Good, thanks. And Ron, you're kind of taking the pointy edge of this in terms of bringing machine learning and data and artificial intelligence to this. Are you seeing that being applied to these larger portfolios?
Yeah, it's interesting, and I think Denise hit on it in, I think, the last or second to last slide. I think with many of those really, really bespoke risks, sometimes you don't have enough data to train accurate models, right? Because one of the core requirements to have accurate models is sufficient data. And when you have really, really bespoke risks that, you know, there might be only a dozen airlines, in like large airlines in the United States, you might not get enough risk data to be able to train a machine how to do that. I do think in the future, as we move more towards like general AI and the ability to have transfer learning and, you know, some of those things, we can apply some data that, you know, has been trained on, for example, on similar but not exactly the same, but I don't think it's available today. So to your point, Mike, or to the question, I unfortunately don't see it being applied today, probably because the data doesn't exist, but I do think it's definitely possible for machine learning and AI to get there in the coming years.
Great, thanks. And Greg, any thoughts from you on this?
Yeah, just two things I'd like to offer here. First of all, I'll just give a couple examples of some interesting thinking that I've seen going on from carriers in particular. One of the examples is if you think about these large risks and you think about how you underwrite them today, really a lot of times what you have your underwriters doing is you're doing a lot of web searching. You're really trying to find interesting correlations of data out there, and you're using the web to do that. So we have interacted with some carriers that have actually just used RPA to model that process, right? So as a risk comes in of this particular profile, you can train a machine to go search for this, search for that, search for this. And what's really interesting about that is it does the same thing that your underwriters would do, and it just speeds up that process for you. So excuse me, that's an example, one example. A second example that I've seen is that, you know, there are these AI engines out there similar to like an IBM Watson, where when you start throwing information at it, it brings back interesting observations that your underwriters wouldn't have necessarily found in the first place, right? So over time, you begin to think differently about how you might want to do underwriting and what you can automate and what you would look for. If you think about the auto industry, probably a couple of decades ago, if you would have imagined that we'd be checking credit rating and associating it with an auto rate, well, that was a new thought, right? But when you get some of these interesting observations back through IBM Watson, just as an example, there's a number of engines like that out there. then you start to think, well, maybe we should be checking on these types of data or this types of correlations. So we've seen those two examples very specifically in some carriers.
Great, thanks. We've got a couple of other questions here that I want to dig into. So basically, this is from Tony, and he says, regulators are deeply skeptical of both dynamic pricing and the use of consumer data, even if consumers are willing to share it. Any thoughts about how to convince regulators these are legitimate underwriting methods? I'll just share my conversations with NAIC here in the US about this. And the net is, they get that this is coming. Obviously, what they want to see is proof in the models, right? So that we make sure that we're actually doing, that the models are correlated to what we can actually measure over time. But I think obviously different regulators in different states here have a different outlook on this, but the more forward-thinking ones basically are trying to figure out how do we help do this, because we believe that will help both the end insured, which is what their job is to do, as well as help the insureds run more profitable businesses. So I don't know if you guys have any other thoughts on that, but that's kind of my conversations with regulators.
I would agree with you on that. It's been the same with mine. And I think once they understand that the people that they serve, whether it's a business owner or a consumer in their state, there's a whole new set of expectations for those individuals or those business owners. And they want to be able to have risk assigned specifically around their personal situation. They don't want to just be one of many. And so I think regulators are increasingly understanding that and are trying to figure out how do they best kind of support that, going forward, so that there's still an element of fairness, across everybody, but yet allowing for that personalized, customized risk. And I think as we look forward, some of the factors that we've used in the risk process, in the underwriting process, may change. Whether it's like your FICA, your financial statements, all those different types of things. Some things may not necessarily be as applicable going forward to really define risk. It could be other types of factors. And I think that's going to be the real challenge, is we may find new sources of data that are going to be more insightful than what we've used in the past.
Yeah, thanks. Yeah, so we're kind of into the discussion now, I think, of kind of what, what it takes to do, really an excellent job, particularly as we move forward in this marketplace. There's a couple of other questions here that I want to talk about, and I want to kind of preamble this. I think what we're going to see as a trajectory of this is we'll move from the work that we're seeing kind of in the personal/commercial, i.e. micro insurance kinds of things, where we've got, insurance for the sharing economy, where my property is a business one point and another point it's where I live, and same thing with the car I drive and so on. So I think we'll see, probably rapid acceleration of some of the innovation in those domains, just because it's bigger and we've got data and it can be more applicable generally. I think the next step along the way is into the small business. And then I think we're going to see a lot of that activity that we've seen in the past in the small business activity for underwriting, where we can be smarter about gathering information about the business using data we've already got, so we don't have to put somebody through 120 questions 3 times before they can get a policy. And the same thing would go along with when scenarios change with that business. Do we have to go back and get that updated, or can we gather that data digitally? I think those things are in play now and maturing pretty rapidly in some areas. And then I think the next step, and I think probably the ground where a lot of insurers are focusing right now, is that mid-tier enterprise, because it's not as big and ugly as the big commercial entities, so it can have some of the characteristics of the smaller ones. But I think there's a lot of profit opportunity out there that people are looking for, so I think we'll see a lot of work done in that. And I think the large, really global commercial accounts are kind of be the last bastion. But I think what's going to happen there is we're going to see specific domains of those businesses that we can underwrite with digital information, whether it's supply chain or those kind of things. I think that's going to accelerate where we're using data and analytics and machine learning to take that work on. So,
Mike, I would just add that regardless of the size of the business, I think everybody's got to step back. Everything changed for every business because of COVID. And it's not going back anytime soon. And it may never go back. And so therefore, the risk profiles of almost every business out there is changed. And there's got to be new data. If we're going to have large swaths of our employees working from home, what's the new type of risk? Cyber becomes a higher level of risk associated to, having employees working from home. What does it mean from a workers' comp standpoint? I think we really have to step back and we have to really rethink, how did we really put together policies and the risk profiles of businesses, assuming that everybody went into work, they had a building, they had a property, they had fleets of cars, they went flying, all those different types of things. None of that really is applicable anymore.
Yeah, and they had supply chains that weren't impacted by COVID, right? So yeah, got it.
Mike, while being an insurtech is great, I love it. I think that sometimes the industry takes the viewpoint that, well, today's baked, so now we need a whole bunch of new stuff in order to solve for tomorrow's problems. And the fact of the matter is, today's not baked at all. It's shocking to me how much risk goes through a commercial pipeline where people have no idea what the peril risk of those properties are, because the schedule's too big and it gets too expensive. And the second thing, which is where Ron comes in, is it's still such a form-based business where people are typing in forms by hand. It's like those are two pieces of the market that you can solve for right now that will have a noticeable and measurable impact on your bottom line, because it eliminates surprises and it makes sure that what is entered is what is judged, and what is judged is what is known. And so all this new stuff, it's terrific. And you're right, Denise, you do have to recalibrate what you currently have based upon the new working environment. But if you can digitally ingest your forms, yes, and you can apply every location with the risk, then you jump points ahead in your underwriting losses, or lose points and you have a better underwriting experience, because you're dealing with so much more known data, and that's available today in the marketplace. So sometimes we get lost in this journey for tomorrow. We need to take a closer look at what's going on today.
Yeah, thanks for that. And I'm just remembering there's a recent study that came out, and I think it was a global study of risk managers. And one of the things that just floored me was that they said, for the most part, they really don't analyze the majority of their top 10 risks. They get to the top 3, but they don't get like doing a detailed assessment of what their cyber risk is, even before COVID came along. They don't do. And I think, so to me, I think there's an opportunity for underwriters and the brokers to really assist in digging down deeper. And I think, as I said in the CEO surveys, every CEO out there realizes that they have to be more agile and more nimble, because, as Denise, you said, their business has changed dramatically and will probably keep changing. And so I think, per your point earlier, what's going to drive excellence in underwriting in the future is really getting outside of our box and saying, what data is out there, right? Where are the sources of data? And you're, Ron, talking about comparative things, right? Where it may not be exactly the same, but where can we basically start to blend data that will give us better insight into those things? So I think, to me, that's kind of the, the future is we need to get out there and be explorers. We can't just, as you just said, we can't sit there and just say, Bob, hey, everything's static. It's not, right? So Greg, I know we've been talking a lot here. I don't know if you wanted to add any thoughts to this.
Well, I was just going to say, I wanted to agree with what Bob was saying, in that I'm honestly amazed. We speak to prospects every day, and I'm sure Denise can relate to this as well. We speak to prospects every day that we look at their processes, we look at what they're doing today, and it is, not only is it just amazingly manual, but at the end of the day, what ends up happening is the risk that gets put on their book has very little data associated with it. We're sort of focused on filling out forms and collecting pretty tactical data, and not really examining risk as much. So, and we see it every day. So I'm still amazed by that. So I just want to highlight what Bob said, in that, you know, if you're a carrier and you're out there and you're thinking, wow, we have to completely transform our system environment. We have to spend millions of dollars replacing all of our core systems. You may not need to do that. What you, you know, taking a piece of the process on underwriting and saying, hey, we're gonna look at 2 more ways to increase our underwriting effectiveness, and we're gonna go look at some different data sets that are out there. Just adding a point or two to your underwriting effectiveness can absolutely change your bottom line, right? And Denise made a couple of points about everything changed with COVID. I agree that everything changed around us, but it doesn't necessarily mean that insurance companies are going to go change because a lot of times we're the last to change, right? And so I would, if you're a carrier out there listening today, I would challenge you to honestly look at how you're doing underwriting today. Just think about it differently and think about the 1 or 2 things you could do to just change or make better the way you could do that process. And there's a number of us in the InsurTech community that would be happy to help think through that with you.
Right, yeah, and I thank you for that. And I was just actually thinking, we do work with a startup that is focused on basically the guy that put the company together, the risk engineer, and for mega construction projects. And he was recounting to me going into the underwriter office, where all the reports come back in from the construction zone about here's what the risk engineer flagged, and here was the recommendations in terms of what they needed to do to address that risk. And those are sitting in files that the underwriter has never looked at, right?
Right.
So it's like, there's risk sitting there in a manila envelope that, if addressed or checked on, could dramatically reduce the exposure for the insurer that isn't being looked at. And I think, that's the challenge with particularly those mega risks, is maybe it's just, some of these things aren't like, we don't need huge machine learning capabilities to address this. We just need to get data up digitally and visualize it, and automate some of the processes that data is received by, to change a few points, in terms of return. There's a question here, what's the scope of standardizing requests for quotes from brokers to expedite the submission, intake, and processing? I know a number of people are working on that. There are also a number of startups that are working on kind of building a more effective matching mechanism between what a carrier's appetite is, what a broker's specialty is, and the risk that's coming in. But maybe we can start with you, Denise, and just
yeah. So I think that this gets to kind of that digital experience. And in fact, we've done this with a wholesale broker, that is actually working with multiple different insurers, to fulfill their customers' needs, and pulling together quotes from multiple different carriers into kind of a proposal that goes out to the customer. And typically today, you're kind of going into the carrier's portals and trying to do the quote, and the information kind of comes back, and then you're trying to kind of piece it together type of thing. And I think that's where digital platform really kind of comes into play, is how do you kind of, through APIs, the technologies that I mentioned before, how do you able to kind of do that process in a personalized way for that broker, to be able to effectively do it for their customers and not be dependent upon that. And what that does is it opens up the possibilities that you can actually bring the best products to the table for your customer, from a broker perspective, because you've kind of got a standardized process, rather than having to kind of use the portal or the standard process for each of the carriers that is vastly different, and doesn't really aggregate the stuff together. And so I think we've got to start thinking about it in terms from a carrier perspective. How are we going to open up our technology through APIs to be able to have the flow of information back and forth into other technologies and digital platforms that are going to allow that ease of doing business? I think we've got to kind of have a different mindset going forward.
Great, thanks. So I want to go
Bob,
ahead.
Sorry, Mike. Can I add a couple thoughts to that?
Please do.
Yeah, so I agree with 100%, and I think we've had an experience on the flip side of the table. We do some work with carriers who, to your point, sometimes if they don't have a portal, can receive submissions from brokers, hundreds of brokers or agents who each have their own looking Word document or PDF template. And specifically where we've seen AI be really, really helpful is around the concept of CNR. So kicking off the first 10 to 15 data points, that's really a good place to start. We've also seen a lot of really good work around the concept of CRM systems. So integrating into Salesforce to create like a client record so you can have a record, and then finally pushing it even further downstream into quoting engines. I've seen some solutions, especially where quoting systems have APIs, which Denise, I'm a big fan of for sure. Like APIs are great technology.
Absolutely.
If the quoting engine has an API, you can imagine basically having a portal, or not a portal, sorry, an email or a portal where the data comes in, it's read in 10 to 30 seconds, pushed into the CRM, the CR, and the quoting engine, and then the underwriter can come in and basically decide whether they want to proceed with the risk. Because as we know, machines can read fast, but they can't make decisions necessarily. That's where we still need trained underwriters, and I think we talked about this a little bit earlier. I don't think that goes away. I think we now have even more value as humans because that's something that the machine cannot do.
Great, thanks. So we've got about 13 minutes-ish, 12 minutes-ish remaining. So I want to jump into some other conversations. Thank you guys for that great input. Greg, I want to start with you on this one, if that's okay. So, we've talked about a number of technologies. We talked about a number of data sets. We talked about a bunch of processes. We talked about trying to get stuff out of paper into basically digital form so that it can be consumed and analyzed and presented more effectively. And what we also talked about is, there's no silver bullet here. It takes a lot of work. So can you maybe kind of take us through, how do you start, right? If you're going from kind of the old school of, kind of a legacy underwriting approach where everything sits in manila folders, et cetera, how do you start to break down, where do you begin in terms of assessing your underwriting process and then figuring out where you want to go first? Because I'm not a big believer in big bang. I believe you want to start, you want to do it incrementally, you want to take an agile approach. But can you share with us kind of your thoughts and some of the experiences you've had in getting these projects underway?
Absolutely. So the very first thing that I would suggest, even just to get started on this process, is you have to look at, first of all, the personality of the carrier. You have to look at almost like the risk profile of the carrier and decide how much that carrier is willing to change, right? And then you take a look at how you're doing the underwriting today, and you'd be amazed at how many good ideas are out there that don't necessarily come directly from the underwriters, but come from people around the process, on how you can just take a piece of the underwriting process today. And for those of you who have been through, Six Sigma types of situations, there's this exercise that we love to take clients through, and it's called the 5 whys. For those of you who've done Six Sigma things. And when you look at your underwriting process today and you take a look at that piece of data and you say, well, why do we do that? And you just keep kind of going through the 5 whys, like, why am I looking at this particular thing? And then once you get that data, what are you doing with it? Just unpacking the process, you will immediately come up with at least 2 or 3 things that you can tweak. And so we always recommend to clients is, before you dive in and grab technology or decide you're going to move forward on a project, really understanding the process, why you do what you do today, what you do with that data, and then just try something. It's amazing how when a client just tries something for a month, that they can just measure it and see, wow, that made a really big effect on how we did something, or that didn't do anything for the process at all. And we especially like that second one, because if we have someone who is teed up to do a multi-million-dollar project and they figured out, oh, that was something that wasn't even going to move the dial, well, that's something that we just saved that client from, right? So, so just again, just to kind of summarize it, it's really just, it's not rocket science. It's sitting down, it's looking at your process, and then it's making sure that you know why you're doing what you're doing, and just trying to change 1 or 2 things to prove it. And I'll close with this. I oftentimes say, prove it on paper first before you jump into technology. And what I typically mean by that is, if you rerun a process and you can write it on the whiteboard and you can look how it might work and then you measure it, you'll get much better results.
Thanks, Craig. And then Bob, I wanted to jump into you because I think, using some of this data that you're capturing is probably new to some organizations, or they've brought it in different ways before. Kind of what are your thoughts about how to start bringing in some of the, what's been successful in bringing in the kind of data that you have to an underwriting process? Where do you start?
Well, where to start is always an interesting question. The business survives through the law of large numbers rather nicely. People still have underwriting profits, even though they're not necessarily optimized for that. So you're always sort of battling that headwind. The way that we see people come on to using our data is either directly through us or through one of our partners, like Greg or Denise. They find a problem area. Okay, I'm having a problem with this area. California wildfire exposure might be a good one, or coastal storm surge exposure. How do I address this problem? Start small, pick a specific problem and solve that problem, and then work your way out. I think that people get very overwhelmed by the comprehensiveness of the data, certainly that we bring, and the data that a lot of folks can bring. So it's important to start small, have a beachhead, and then expand out the use after you've made that initial proof. Whether you write it on a wall, which I think is a great idea, it's how we do our development. But it's always take a bite. How do you eat an elephant? One slice at a time. Not that anybody should be eating elephants, but that's how you do it. It's one slice at a time. Pick that slice that hurts, fix that slice, and then move on from there.
Got it. And then Ron, just from starting to bring machine learning and artificial intelligence into this process, data is always kind of the first stop along the way. But how do you get started? What does success look like?
Yeah, I think that is the right question, Mike. I think, what does success look like? So I would say, a business case. We often talk about, innovation, and innovation is great, but innovation for the sake of innovation by itself is not going to lead to fruitful results. And so having a business unit, like we talked about, taking a chunk, you choose one business unit, don't choose the whole business, choose one business unit, identify a specific problem you want to solve. Let's say it's submission intake or policy check or claims. Identify what type of specific you want to deal with, like what unit within that, and then build a strong business case. Like we talked about, don't invest $1 million if you're not going to make $1 million back. Right? I think Greg talked about that. So make sure that the business case makes sense. And then finally start off in a small POC. Once you've proven it out in a POC, you can go into production. And then the final thing that I'll say is also recognize that startups, or insurtechs especially, are not quite as big as some of the big establishments. And so try to have a procurement light process. Many deals die on the grapevine because it takes so long. And so try to have a procurement light.
Gotcha. Okay, so Denise, any thoughts from you that you want to add?
Yeah, I would just add a couple of comments. I think that as you're looking at the different technology, as you're looking at a technology to be able to do the underwriting, to be able to bring that up to an aggregate basis for the data, but also potentially from a portfolio perspective. Too many insurers have lots of systems, policy systems, legacy systems for different lines of business. And if you're looking at things at a portfolio basis for a business, it could go across that. So you're going to have to think about, a digital platform that's going to be able to go across multiple different core systems. I would also suggest that I agree, that you want to kind of whiteboard it, but I think the power of some of the newer technologies is the ability to test and learn. I think we've got to get beyond, just trying to make everything perfect and then we can implement, to outlining a kind of an overall process and having a technology that's going to be able to adapt, not just as you're building it out for the first time, but adapt to all the changes that we're seeing in the world and the pace of change. But being willing to be able to do that in a test and learn, go out and test it and then bring it back and adapt it. To be honest, that's what Lemonade is doing. They're testing and learning all the time with their algorithm based upon their claims process. what's happening in claims based on how they underwrite. They come back and they update their algorithm, and it's a constant test and learn, and it's a constant updating process, and that's where we really have to get to.
Yeah, so thank you. And I just want to double click on what both of you guys just said here, because I think the net is, in many insurers' mind, like it's whatever they do, it's a 9 to 12 to sometimes 36-month process. And the net is, that's not the reality anymore, right? The reality is we have the technology to do this stuff much faster, to bind stuff together, whether it's because of platforms that are out there, APIs and microservices that are out there, or the low-code, no-code platforms that are out there. We have the ability to put this stuff up, test it, evaluate it, and change it far faster and far more quickly than we ever did before.
Hey,
Mike,
let me add one quick thing. Something
yep,
a
and we got
commercial.
3 minutes left, so.
Okay, something an insurer can do today is to create a test data set that you know very well, that's got premium and claim information that you can give to anybody and say, here's my test data set. How do you rank against my test data set? That will speed your own innovation process by months, because the hardest part is getting a consistent data set that people know very well.
Yeah,
And,
dead on. Thank you. All right, so real quickly, I'm going to summarize, kind of like, one of the things we wanted to get to is how to make the business case for this. One of the questions we got here is, how is it that we've got all this stuff in this capability and insurers are still writing business without it, and they're still profitable? The net is, many of them aren't particularly profitable. And I think as we move into this digital age, those that haven't cleaned up their act in this and kind of moved digitally are going to get hurt pretty badly. You look at where the market is, returns on investment portfolios and stuff are getting thinner, et cetera, et cetera. So it's time to get the underwriting act together. And I think the net is, the bigger the underwriters and the bigger brokers out there, they are starting to focus very heavily on how do they basically get better at this. So I think the message is, this digital wave is coming faster, and if you're not in front of it, you're going to be under it. So that would be kind of my 2 cents on how do you make the business case for this. Do you guys have any other thoughts that you want to add before we wrap?
I'll just agree with what Denise said about testing and learning. A lot of times in large corporations, big insurance companies or mid-tiers, there's a lot of energy put into doing these giant business cases for millions and millions of dollars. And I agree with Denise. Choose a problem, put it out in the market, test it for 30 days, and you'll get a lot further ahead.
Yeah, and I was going to say, there's a bunch of research out there that's come in recently looking at digital transformation across industries. One of the things they've found is that the people who actually deliver the greatest amount of business results from undertaking these projects are people who do just exactly what you just talked about, Greg.
Yep.
They're not trying to swallow the elephant, right? They're basically taking on a little bit at a time, proving it out, and moving it to the next one quickly. All right, so that's all we've really got time for today. We're at the top of the hour. So let me pop my slides up again here. I'm going to share my screen. It'll kind of be a mess to start, but I'll fix that quickly. So let me get this up. So again, thank you everyone. It was a great discussion. I certainly learned a lot today. I hope our audience did as well. Again, I want to thank our sponsors, Majesco, Instinata, Chisel AI, and Hazard Hub. As I said before, please reach out to us via LinkedIn. We'd love to talk to you if you've got other questions and insight that you'd like. I'd also like to thank our speakers. Everyone, you guys did a great job today, so thank you. Again, we've got more of these webinars coming. We've actually got one tomorrow on the future of commercial insurance distribution and customer engagement. So love to have you guys tune in for that one. And with that, I'd like to say thank you to everyone. Thank you to the attendees. Thank you guys for all the great questions. Tony and Arturo, you kind of led the charge here. So thanks for that. Much appreciated. And that's a wrap. Thanks, guys.
Thank you.
Thank
Thank
you.
you. Bye-bye.